This is Nightly Business Report with Bill Griffith and Sue Herrera.
Big tech comeback. The group closes at a new high, a big move considering it was battered and bruised just a few months ago. Shifting gears. The major automakers are embracing electric vehicles and making green more affordable for drivers. Sweet idea? Can a company known for its gold box of chocolates find growth by expanding into an ultra-competitive industry? Those stories and more tonight on Nightly Business Report for this Wednesday, April the 17th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. Don't look now, but big tech is making a very big comeback. That sector has been powering higher the past few months, and today the NASDAQ 100 closed at a record high. That index is a basket of the 100 largest and most actively traded companies on the NASDAQ, which is made up mostly of technology stocks. It's a remarkable turnaround for a group that was beaten down just a few months ago. Bertha Coombs starts us off tonight.
The NASDAQ 100's gains today were driven by Apple and chip technology firm Qualcomm after the tech giants announced that they had settled their long-standing patent dispute. Large-cap tech names dominate on the NASDAQ 100, and it has been their strong recovery in 2019 that has pushed the index to a new record high after what was a brutal year-end of 2018. The semiconductor sector is a prime example. Semis fell 18% in the fourth quarter, and concerns a U.S.-China trade war would make it difficult for manufacturers to import chips to the U.S. But trade headlines have improved. Chip makers have seen a strong recovery with new highs today for Qualcomm, Intel, and Broadcom, and a new record for the sector. The biggest contributors to the NASDAQ 100's gains year to date have been four of the tech heavyweights that suffered big losses in December. Facebook is now up 36%, Apple up 28%, Amazon up 24%, and Microsoft up 20%. But the next big catalyst for this group is going to be earnings, with all four scheduled to report in the next couple of weeks. For Nightly Business Report, I'm Bertha Coombs at the NASDAQ.
Timothy Lesko joins us now to talk more about technology and what's driving it. He's principal at Granite Investment Advisors. Tim, always good to see you. Thanks for joining us tonight.
Well, thanks for having me, Bill.
So just a few months ago, as Bertha was pointing out, down so sharply, and now we're back. But does that mean the problems that were plaguing the group, the problems with semiconductors, the slowdown in sales for smartphones, the trade concerns, are those gone now?
I wouldn't say that all of the concerns are gone, but a few of them have been taken off the table. Particularly, investors see that the Chinese trade negotiations seem to be going well, or better than anybody expected. And on top of that, a few of the individual stocks had some very stock-specific news that went their way. So it was a nice combination of both stock-specific news and market news in general.
And what are your expectations for the earnings that she was just mentioning for some of these giants that are to be reporting soon?
Well, the same factors that brought the stocks down pretty heavily in the fourth quarter of last year led to analysts really cutting their estimates. So these companies don't need to grow that much to beat the lower expectations that Wall Street has set for them over the next few weeks. So we expect a good earnings season out of technology.
And what about the semiconductors? I mean, they are a benchmark for the whole industry right now, and they have suffered greatly. What's your outlook for some of those companies right now, the Intels and others that are out there?
Right. Well, certainly you have Intel, Qualcomm, and Broadcom, which Bertha had mentioned. All three of them had very, very specific reasons why they were struggling against a broader tape of technology that had done well. And each of them have solved those problems that we were worried about. So in Intel's case, they are getting out of the 5G chip business, which they were really struggling in. And investors saw that as a really positive light. So we really have good expectations for all three of the major chip makers, and all of them are trading at a reasonable valuation. So there's plenty of room for them.
All right. Well, so far so good for that group as it moves higher. Tim Lesko with Granite Investment Advisors. Thanks again for joining us tonight, Tim.
Thank you for having me.
And it's not just the tech sector moving higher. Other parts of the U.S. and global markets have also been rallying. Just not today. The Dow was down 3 points. We were at 26,449 at the close. The NASDAQ fell by 4. The S&P 500 slipped by 6. Bob Pisani, though, has more on what has been working for investors.
The U.S. bucked the uptrend in global markets on disappointing earnings from IBM and continuing weakness in healthcare. But markets in Europe and Asia were up as China reported better first quarter GDP numbers than expected. GDP has been declining for years in China. The anticipation of a bottom there is the main mover of the global stock market in the past couple months, on the heels of the massive stimulus over there and the hopes for a trade deal. The S&P 500 isn't the only major index at or near a new high. Stock exchanges in Russia, in China, in Saudi Arabia, all at 52-week highs. India is at an historic high. The other main mover of stocks has been earnings. Fear of an earnings recession, 2 or more consecutive quarters of declines in earnings on the S&P 500 are dissipating as China avoids a meltdown and Europe kind of just muddles through. Analysts dramatically cut earnings estimates in December on those fears, and they appear to have cut too much. Just look today at the companies that are beating earnings by very wide margins, including Netflix, Morgan Stanley, and Textron, all beating earnings estimates by double digits. That's far more than the typical earnings beat of about 3%. Only IBM, with weak earnings growth and negative revenue growth, was a major disappointment today. As a result, many sectors in the S&P are at or near new highs: technology, consumer discretionary, consumer staples, and communication services. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
More now on those growth numbers out of China overnight, which seem to signal stabilization in the world's second largest economy. And it comes after that country flooded its economy with stimulus money. Eunice Yoon reports for us tonight from Beijing.
Investors have been asking if China's economy is bottoming out, and it appears to be stabilizing. China's GDP for the first quarter came in at 6.4%, slightly beating expectations of a further slowdown. Industrial output was its strongest in 4.5 years, 8.5%, possibly because the U.S. and China have been holding back on tariffs, as well as seasonal factors. Manufacturers were in full force after the Lunar New Year holiday in February. The Statistics Bureau said Beijing's recent policy steps, like tax cuts for consumers and local government bond sales, showed up in the March data. Retail sales jumped, fixed asset investment picked up, construction starts jumped 18.1% year-on-year from 6% in the previous months as the authorities loosened real estate curbs. Analysts believe that this could mean China's policymakers will hold off on further stimulus for now. They also have to worry about another factor: rising prices. Pork production fell by 5.2% year-on-year as China attempted to contain an outbreak of African swine fever in its hog population. Prices are expected to rise by more than 70% in the second half of the year, putting upward pressure on inflation. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Let's turn to Mark Grant right now for more on the global markets. He is the global market strategist at B. Riley FBR. Mark, good to see you again. Thanks.
Hi, Bill. Good to see you.
So,
always a pleasure.
The biggest concern, let's face it, in the global economy has been China. What did you think of these numbers overnight? They were pretty impressive.
They were certainly much better, Bill, than most people thought. The issue in my mind with China is the amount of stimulus that the government has been providing and the increased amount of debt, not only corporate debt, but public debt in China, that I think has gone a long way to stimulate their economy. Plus their central bank, the People's Bank of China, has been adding quite a bit of money into the economy, and it's I think that's a big cause of the upward move here.
So you're concerned about that part of the equation, but what about the trade talks? We hear that the progress continues and they hope to have something signed by next month.
You know, that's what they say. They've indicated this before. I hope they do. I think it'd certainly be good for the markets both in China and the United States if this gets accomplished. So we're all sitting around on Wall Street with our fingers crossed.
Yes, indeed. Are there other parts of the global economy that you like better at this point, that you feel present better? We had an analyst last night saying the emerging markets are attractive right now. What do you think?
I don't think that's correct. My favorite market of the global markets right now is the United States because of the stability, because of very low interest rates, because the Fed has changed its course. My biggest concern, by the way, isn't China, it's Europe. Europe on May 23rd has its national elections, or its elections across the whole European Union.
Right.
And it looks to me like, Bill, that the group that's controlled the EU since inception, which is the German-French alliance, the populists or the nationalists is what I think the better word is, but are going to get either a significant share of the new EU Parliament, or they might even get the majority of the new EU Parliament. And I think the European Union is going to be a very different place. So I'm very cautious on any investments in Europe right now.
And very quickly, all of the central banks around the world, except ours right now, seem to be loosening their monetary policy. And you've mentioned China, but elsewhere, does that bother you at all?
Well, I think it's positive that interest rates are lower without any question. The Japanese central bank, they have a balance sheet that's equivalent to the entire GDP of Japan. The ECB has a balance sheet way larger than the Fed's at this point, and they're going to be lending more cheap money to the banks over there.
Right.
And the Fed has done a backflip, if you will, and has stabilized interest rates. I think that's been a very positive for both the bond and the equity markets in the United States, and I think that's going to continue.
All right. Mark Grant with B. Riley FBR. Again, thanks for joining us tonight.
Thank you, Bill. Thank you, sir.
You bet. Speaking of the Federal Reserve, it released its monthly anecdotal look at the U.S. economy today, and it showed moderate growth despite continued trade tensions and the severe flooding that we saw in the Midwest. Steve Leisman has more on the Fed's Beige Book.
The Federal Reserve's April Beige Book finding slight to moderate growth in the 12 districts of the Federal Reserve. It's a similar report as last time, but some districts did see strengthening. Consumer spending was mixed with sluggish sales for general retailers and for autos. Now, the context in many districts reported, quote, trade-related uncertainties with about as much concern mentioned about trade and tariffs in this report as the last one. Employment, though, continues to increase, with a majority of districts saying there was a shortage in high-skilled jobs. Continued wage pressure, especially for those high-skilled jobs, and most districts are saying there was modest wage growth. Prices overall were up modestly, with input costs increasing, including higher fuel prices, tariffs, freight costs, and rising wages, all driving the pricing trend here. In St. Louis, retailers expected to be able to pass along their higher prices. Oh, by the way, in St. Louis, there's also concern about flooding in Minneapolis and in Kansas City as well, affecting the agricultural industry. Back to the wage issue, Dallas reported elevated wage pressure. Philly, more than half of all firms expected higher input costs. In New York City, there was a widening gap between the salary demands and salary offers that left some positions unfilled. For Nightly Business Report, I'm Steve Leisman in Washington.
One other bit of economic news, our trade deficit with the world fell in February to its lowest level since June of last year. That was well below what economists had been expecting, and the decline was due in large part to a 28% decline in the goods deficit with China as exports to that country rose. In the meantime, as we mentioned, trade negotiations with China are moving along. According to Dow Jones, the U.S. and China are expecting to reach a deal as soon as May, with the two countries setting a tentative timeline for the next round of talks that involves Trade Representative Robert Lighthizer going to Beijing the last week of April. Elsewhere, we take a look now at some of today's upgrades and downgrades, with Bank of America being downgraded today to hold from buy at Jefferies. The analyst cited some challenges when it comes to fees, service charges, and net income. Price target now $32. That stock was up a fraction today to $30.03. PayPal was downgraded to neutral from buy at UBS. The analyst says the monetization of its Venmo app is already priced into that stock. Price target now $120. Shares were up modestly to $108.81. And ride-hailing company Lyft was initiated with a neutral rating at Susquehanna today. The analyst says that Lyft investors should be concerned with the company's position as the number 2 player behind Uber, which will debut on its own on Wall Street next month. Price target on Lyft, $57. The stock was up nearly 6% today at $59.51. Still ahead, automakers are plugging in.
I'm Phil LeBeau at the New York Auto Show, where electric vehicles like this one from Rivian are turning heads like never before. Why are so many people now considering an EV? That story coming up on Nightly Business Report.
Zoom, one of the highly anticipated high-tech companies coming public, reportedly has priced its initial public offering at $36 a share. That was above the expectations. As we've been reporting, Zoom is profitable, which sets it apart from some of the other tech companies that are coming public. Shares will begin trading tomorrow on the NASDAQ under the ticker symbol ZM. Well, one day after Qualcomm and Apple ended their long-running legal battle, the CEO of Qualcomm today said that he is looking forward to working with the iPhone maker. During an interview, Steve Mollenkopf also said that now is the time for his company to look to the future and focus on new opportunities, including 5G.
We did put the pedal to the metal on 5G. I think it's the right thing to do for the company, independent of this relationship, and I'm sure it was important to this relationship as well. It's a lot, the impact of 5G is just going to be tremendous, not only in the handset space, but outside of the handset space. We think we're the clear leader, and I think that's going to be a good thing not only for our customers, but for our shareholders.
Qualcomm rose another 12% today, adding to that 20% gain we saw yesterday. Pepsi shares rose to a record high today after the company reported solid quarterly results and said the investment in its snacks business is paying off. That sent the stock up more than 3.5% to that all-time high. Sarah Eisen has details.
PepsiCo is turning up growth a notch, posting its best sales growth in about 3 years. The key number for PepsiCo, organic revenue, growing 5.2%. What's behind that kind of growth? Well, snacks, for one, is doing much better. Growth in Frito-Lay in particular, the core brand, fueling the gains. But also North American beverage business has come back lately. Hugh Johnston, the CFO and vice chairman of PepsiCo, says the portfolio is just working.
I think it's a combination of two things. Number one, you see continued portfolio strength, whether it's our U.S. businesses, our international businesses, across snacks and beverages. We just continue to see strong, broad-based performance. In addition to that, our North America beverage business really has been strengthening over the last couple of quarters as we've invested in more advertising, we've invested in more execution.
PepsiCo is spending a lot more these days on advertising, just like Coca-Cola has been doing. It's also seeing better execution. For instance, when it comes to the sales force on the ground, just placing product in the store, Johnston tells me they've seen a lot more efficiencies, and that's led to higher profits and higher sales. He also sees a pretty healthy consumer globally.
Within our segment of the economic world, we see a consumer that is capable of spending and is willing to spend on products that they really see as differentiated and adding value. And that's what's driving our focus behind putting money behind advertising, putting money behind innovation, because when you deliver something different that the consumer likes, they're certainly willing to pay for it and buy lots of it.
The market has already reflected Pepsi's new growth prospects. The stock has outperformed Coca-Cola and the rest of the staples so far in 2019, and it certainly ups the bar for Coca-Cola reporting earnings next week. It's been hit a little bit harder by the strength of the U.S. dollar because it has a much bigger international business. For Nightly Business Report, I'm Sarah Eisen.
Morgan Stanley topped Wall Street earnings and revenue estimates. And that's where we begin tonight's market focus, with the bank citing growth in its wealth management unit, as well as on cost cuts. James Gorman, the CEO, said that overall results were solid despite a slow start to the year. But on a call with analysts, he also said the outlook remains uncertain.
The world remains uncertain. I'd love to think the next 3 quarters are better than the last 3 quarters of last year, but I'm a betting man. I'm not sure I'd make that bet right now. The world is uncertain, and until we see more clarity, we're going to be very disciplined. There's not a panic. It's just good, smart expense management.
Morgan Stanley shares rose more than 2.5% today to 48.26. U.S. Bancorp reported a rise in commercial and mortgage lending, as well as in some of its payments businesses, and that helped the company report earnings that were in line with expectations, although revenue was slightly below estimates. The CEO said the company was helped by rising interest rates and higher yields on securities, and shares rose a fraction today to $50.67. American Airlines says it cannot yet forecast the cost of the 737 MAX groundings. The carrier says it's still too early. There's too much uncertainty around that issue. Earlier this week, you may remember American canceled all 737 MAX flights at least through mid-August. That stock was up 1% today to $34.38. And U.S. railroad operator Kansas City Southern topped first quarter earnings estimates. Its revenue was up 6% from last year, and it was helped by an increase in refined fuel and grain shipments to Mexico. The company gets 1/3 of its revenue from that country. The stock rose 4% today to $122.81. Abbott Labs also reported a healthy profit and a rise in sales thanks to growth in its heart and diabetes care devices. The CEO said the company's long-term growth drivers are performing well, and he's targeting another year of strong sales. But investors apparently are focusing on regulatory uncertainty with that talk in Washington about changes in health care insurance programs, and the stock fell more than 4.5% today to $72.88. After the bell tonight, Las Vegas Sands reported higher revenue and better than expected profit. The gaming company cited growth in Macau, which is now the world's largest gambling market, and that sent that stock higher in initial after-hours trading. It finished the regular session at $67.91. While auto sales are gradually slowing, automakers believe that America is finally warming up to buying an electric vehicle. And that may explain why plug-in models have been grabbing all the headlines at this year's New York Auto Show. That's where we find Phil LeBeau tonight.
From electric pickups to luxury plug-ins to crossovers like the Jaguar I-Pace, automakers are embracing EVs like never before.
The performance is phenomenal. The driving dynamics is unlike any other car. So customers are starting to really see the benefit of an electric vehicle as an everyday commuting vehicle. It's part of the conversation.
The conversation was sparked by Elon Musk and his company Tesla, which started rolling out luxury electric models 6 years ago. Now with the Tesla Model 3 starting at $35,000 and a base model Chevy Bolt selling for under $40,000, going green has become much more affordable.
The entry-level cars are now 30, 40 grand, where they used to be 50, 60, 70. And frankly, those 30, 40 grand cars are going twice as long on battery as the cars 2 years ago did on 70.
While traditional automakers like Audi are driving the EV discussion with new plug-ins, there are also startups like Rivian, turning heads with an all-electric pickup scheduled to go on sale in 2021.
Critical for us to get customers in is the vehicle has to give them a very strong reason to switch from an existing brand, whether they're in a truck or whether they're in a Land Rover or a BMW. It has to give them a really strong reason.
Buyers may be more interested in plug-in models, but electric vehicles still make up less than 3% of all U.S. auto sales. Proof the industry still has a ways to go before it can convert electric vehicle interest into actual sales. Phil LeBeau, Nightly Business Report, New York.
And to read more about the New York Auto Show this year, you can head to our website right now at nbr.com. When we come back, can Godiva find growth outside their famous gold boxes of chocolate? Companies certainly are always looking for new areas of growth, and today a company best known for its chocolate is hoping to find the next leg of growth in cafes. Courtney Reagan is in New York City for us tonight.
When consumers think about Godiva, premium chocolate gifts is likely what comes to mind. After all, that's the history of the nearly 100-year-old chocolate maker that sells in 105 countries and 800 retail locations globally.
Here you go. Enjoy. Have a great day.
But Godiva's CEO has a big plan to grow the business, and a big part of that is new Godiva cafes.
We feel that that could be a big piece of our growth for the future. In fact, around 40% of our revenue in the future could come from these cafes. We believe that we have the opportunity to five-fold our business over the next 6 years.
This new Godiva cafe opens officially in New York City on Thursday. It's just one of 2,000 planned around the world. 400 ultimately will be in the United States. They sell chocolate, of course, but also different coffee drinks and quaffles, which is a cross between a croissant and a waffle. Young Scrivener brings food and beverage experience to Godiva. Before running the chocolate maker, she ran Starbucks digital and loyalty businesses. And before that, she ran Starbucks tea brand, Teavana. The food and beverage sector is a crowded space and not without risk. Starbucks had nearly 400 Teavana stores under young Scrivener's leadership, but ultimately closed all of them 2 years ago. There's the expense of securing real estate in high-traffic locations, hiring and training employees, and convincing consumers to allow treats into their diets.
Before they were only a chocolate, if I may say, a store. Now they want to go into fresh foods. The supply chain is going to be very different. How well have they thought about the supply chain is also going to be very critical in this space.
Godiva hopes the cafes provide a halo effect, spurring other purchasing.
It's an opportunity to really open up digital, where you could order online, pick up in store, and that makes it really easy for our customers as well.
Kind of like the Starbucks app?
Or better.
What's your name? Young Scrivener is confident in her plans and says the taste and experience the Godiva cafes offer will be the deciding factor for consumers. For Nightly Business Report, I'm Courtney Reagan in New York City.
And that is Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching. We'll see you tomorrow.